Hi, good afternoon, and welcome to Region 5's Lunch and Learn. We are here with Julie, and we are going to be talking about financial success today. Please hold questions either until the end of the presentation or shoot them in the chat, and we can get to them after your presentation is over. So thank you so much, Julie, for joining us today. Take it away.
Thanks, Hannah. Hi, as Hannah said, my name is Julie Anderholm, and I am a consultant with the Small Business Development Center located in Brainerd, Minnesota. I have, oh gosh, too many years, decades of experience working with small businesses and have kind of honed a few topics under the financial success area that I think that hopefully you'll provide this will provide some benefit for you either as you're starting your business or operating your business. The tricky part about discussing finances with businesses is everybody's at a certain experience or knowledge level. So I'm hoping that everybody gains something from this presentation, whether it's one or two takeaways or many takeaways. That's my hope for you. So I'm going to share my screen and we are going to hop into the presentation right off the bat. All right, so this is the Business Bootcamp. I believe this is session 3 out of 4, and we are talking about financial success today. The one thing I think that's important with financial success is really understanding your financial statements. And that's what we're going to be targeting today, is looking at financial statements and hopefully giving you a few tips to analyze them and also make them a little bit more user-friendly for you. So as we move through a little bit about myself, I have a BS and an MBA in finance from the University of Minnesota, and I've worked on financial and general business consulting for the SBDC for the past 25 years, a little bit more than that. I also do independent financial contracting and consulting with different groups and some with the Initiative Foundation with Region 5, but I've also worked for major corporations like Aetna Insurance and Blue Cross and Blue Shield. So I have a pretty varied background when we talk about business finances, and hopefully that'll relay in some really important information for you today. I'm a wife, I'm a mom, I run marathons, I love to garden, and I love to travel. In fact, I just got back yesterday from a 10-day trip, and so hopefully my mind will be sharp enough for you today. All right, we're gonna dive right in. So talking about financial success, our goals for today are we wanna learn how to read an income statement. And oftentimes we look at numbers and we say, well, what do you mean reading numbers? But hopefully it'll become a little bit more clear as we work through the session today. We're going to look at different types of methods to analyze an income statement, percentage of sales, trend analysis, and hopefully give you a really solid background as to how to read your income statement. We're also going to be covering the balance sheet and cover the balance sheet basics. If we think about financial statements, usually it's the income statements that's the statement that you should understand. Sometimes the balance sheet is considered or may be considered more of a secondary statement, but it has super great information that you can use to manage your business. And I'm hoping that today we'll be able to, you'll learn a few tricks on that and understand the balance sheet a little bit more. Lastly, we're going to get into a little bit of projections. And I like to work with cash flow projections and really look at where a business bottom line cash position is going to be. Because as we'll look further into the slides, cash is really king, and a business has to be strong and have a strong cash position in order to be successful. The please participate was probably put in there when I thought we were going to be live and not virtual, but feel free to send any questions through the chat. Hannah will be monitoring that, and we'll have time for questions at the end of the session. And we'll probably wrap up in under an hour and a half, I would assume as well. They usually go a little bit quicker when they're virtual versus live. The last thing I will say is I have a bit of a cold today, so you're going to see me probably drinking a lot of fluids, and hopefully that'll be okay and you'll still be able to understand me. All right, so let's hop into our first slide. We're going to dive right into reading an income statement. So first of all, I want to just point out that an income statement is the same thing as a profit and loss, or the same thing as a P&L. Those terms are used interchangeably. So maybe on the system that you're using to create your financials, it's called a profit and loss or a P&L versus an income statement. Don't be alarmed by that. They're all the same statement. Or sometimes people just say, this is the monthly report that my accountant prepares. Hopefully by the end of the day, you'll really understand what the income statement, the profit and loss, the P&L, what that solid name really means. All right, so as we look at this, the income statement is basically made up of three main components: sales, cost of goods, and expenses. Three components: sales, cost of goods, and expenses. We've got a couple formulas that generate bottom line or numbers that we analyze using these three components. So if we look at this slide, sales less our cost of goods sold equals our gross profit. Our gross profit is used to cover all of the expenses that the business incurs, and what's left over is the net income or net loss, hopefully not a net loss. So again, sales less cost of goods sold equals gross profit. Gross profit less the business expenses equals net income. So really three components with a couple calculations, and that's the whole statement. So if you're ever confused about, again, just what an income statement truly is, this is the key. This is the key to the understanding. If you understand that there's three components, two formulas, and the bottom line is your net income, you'll be good to go and well on your way. So let's dive into these components a little bit further. When we're talking about our sales, this is the number, this is the first of the three components, is our sales. We sometimes, in most cases, we'll maybe want to break business sales down into more than one category. And the example that I'm going to share with you today, we're going to see multiple categories, or what I like to call profit centers. Where are the profits? Where are the sales coming in? Where's the natural break to break those sales for a business down? We're going to be using a bird house sales and bird class revenue model today with two profit centers. But let's look at another example. If you are an auto repair place, your two profit centers might be the labor and the parts sold. Because in order to repair the auto, you have to buy certain parts, and the business is going to profit. They're going to sell those parts at a little bit higher rate than they would have purchased them at. But then there's also the labor component for them to do the business. So those would be two profit centers. And so that's an example of you're taking your overall sales and you're breaking them down into profit centers. We want to look into or breaking that down into as much detail as useful. We might not need 10 different profit centers or 10 different line items under our sales category, but maybe 2 or 3 gives us just enough detail to manage our business better than just having everything lumped into one sales category. So we're going to be taking looking at some examples of that today. Our second component that we're going to talk about is the cost of goods sold. Now, you've maybe heard of COGS. COGS just stands for cost of goods sold. So if you're a business that sells a product, you're always going to have a COGS or a cost of goods sold. If you're a business that provides a service, then you won't have a cost of goods sold, because if you look, the biggest component or the first component of the cost of goods sold is the material cost. So again, if you look at that auto repair shop example, the parts that they're using, that's the raw material. In order for them to complete the job, they need that raw material. So that's going to be a cost to that business. They have to pay for it. So that's a cost of goods sold. Sometimes direct labor, like if you're a manufacturer, direct labor is included in your cost of goods sold. So for instance, if you're manufacturing a tool, the steel or the paint or the glue or the nails or whatever, and that's comprised of that tool would be in cost of goods sold. And potentially the labor costs to actually manufacture that tool would be in the cost of goods sold as well. Whereas other labor for the secretary, for the receptionist, for the accountant, that might be in more of the business operations expense. So sometimes direct labor is included in that cost of goods sold amount. If we can break down these costs, the material and the labor costs, in the same categories as our profit centers that we have up above, that will provide even better information to manage your business. And again, I will show you an example of that. So if you're a service industry, you may not have cost of goods sold or probably won't have cost of goods sold. If you're selling products or are a manufacturer, you will have cost of goods sold. So again, our gross profit is our sales less our cost of goods sold. Our expense are all the other expenses that the organization incurs. So for example, if there's rent expense, if they have to lease a piece of equipment, that's lease expense, utilities, telephone, internet, insurance, those are all expenses that a business incurs, and they are categorized in this expense area. So with our gross profit, we back out all the expenses, and what we have left is our net income. And that's really the profits of the business. So again, sales less cost of goods sold equals gross profit, less all the business expense equals our net income. So when we look at this, let me hop to the next slide here. There we go. We want to utilize this income statement or this profit and loss or this P&L data to help manage your business. So when we look at an income statement, we don't look at it just in one day. It's over a period of time. Typically, it's monthly. So when you look at preparing your financial statements or your accountant preparing your financial statements, in particular your profit and loss, you would want to do it at the end of the month, at the end of a quarter, or at the end of the year. And probably all three, to tell you the truth, because you want to track this data or track this information on a monthly basis. It's always important to run your reports at the end of the month versus in the middle of the month or the third week of the month, because typically at the end of the month, everything is paid, right? Everything is cleared up. So you've paid your rent, you've paid your utilities, you've paid for your telephone, versus if you run a report on the 15th of the month, well, maybe you haven't paid your rent yet, or maybe you haven't paid your utilities yet, or your telephone bill. And so if you are trying to compare different months or even from a different year to that time period, if you run that report in the middle of the month, chances are some of that data isn't complete. All those payments haven't been made. And so really think of, if you're going to do your income statement or profit and loss analysis, you run those reports at the end of the month, at the end of the quarter, at the end of the year when things are closed out. Okay, so let's get a little bit more detail. Usually they're by month, because if there's an issue, you always want to catch that problem early. And if you don't run your reports on a monthly basis and do some type of analysis on a monthly basis, you could encounter a problem. But if you don't run that report in that month and you don't look at it for 2 or 3 months, well, then that problem could have grown bigger or gotten worse or multiplied over those months that you haven't looked at your financial statements. So if you look at things on a monthly basis and do this analysis on a monthly basis, you'll hopefully better manage your business, be able to identify problems and correct those problems sooner. And from the other standpoint, if you're making a change and it's going really well, then you'll be able to see that change and the impact on your business quicker and know that you're doing something correctly or it's the right thing to do. We're gonna analyze by month. We always want to add a year-to-date column. YTD is year-to-date. Okay, so we want to know what our totals are up until that point of the year. We always add a total column. You can add a percent of total sales column. And we may even look at prior year totals and percent of sales to do some comparative analysis. So at this point, I'm actually going to hop to a screen to kind of show you what I'm talking about in real life. Okay, so let's look firstly at this income statement that I have. And it might be a little small. I'm hoping you're going to be able to see it on your screen. But let's look at what we've talked about today. This is an income statement. This title could be a profit and loss as well. Remember, they're interchangeable. So here we have our sales. Here we have our cost of goods. Sales less cost of goods equals our gross profit. And then as we go further down, we have all of our business expenses. And if we take our gross profit and we back out the expenses, we see we have a net income or a net loss. In this case, we've got a few months here that the business is actually incurring a net loss. Okay, so those are the three main categories, the two calculations, and we can see it in this income statement. Let's look a little bit further. Remember when we talked about the sales being broken down into profit centers and providing additional detail to help manage your business? Well, if we look at this business, All About Birds, sells bird houses, and we see sales amounts for just the bird houses. But then they also offer bird classes, and they secure revenues from those bird classes. So we have two different profit centers, if you will, that we can track those revenues by and do analysis on. When we look at our cost of goods sold, we've broken down into the birdhouse materials, the actual product, the wood, the screws, the paint to make the birdhouses. And in this case, we've included birdhouse labor, that direct labor of the people who are actually making the birdhouses, into this cost of goods sold line. We also have bird class materials. There's a little bit, we're assuming that they're handing out some like information on birds during the bird classes. So it's the cost of that. And in the classes, they also serve lunch. So we're gonna count those as cost of goods sold. It's the cost that the business is incurring to provide that bird class for those bird students. We also are including the bird class labor. So these are the people who are providing, this is the money that we're providing for that labor for the people who are leading the bird classes. So again, we are breaking the cost of goods into as much detail as we have under the sales category. So we have birdhouse sales, we have birdhouse cost of goods sold, we have bird class revenues, we have bird class COGS as well. When we look at the expenses, we have a reasonable amount of lines here. Sometimes I've worked with businesses and they've had literally like 4 pages of expenses. And I think I actually consult with them and say, this is a lot of information to try to manage on a monthly basis. Is there a way to roll it up so you maybe have less categories? And if there's a question, you can look into the detail, because you can have too much information as well as too little information. And the trick is to find that sweet spot. Where's just the right amount of information that you will have to manage your business effectively and appropriately? And that's what we want to find out. Okay. And every business is a little bit different, but as you're thinking about yours, what information do you really need to see? And what information could be lumped together potentially with another category? And that's the big question to ask. And here we've got a reasonable amount of line items. And if you can see, our gross profit less our expense equals our net income or net loss. We talked about in the slide previously that we would want to always include a total column. So here this is an income statement for the full year of 2021. So all the months have been completed. And here we have our total column, which is very important to get that total information. Because if you look we have a net profit for the business if we look at the full year, whereas we have some months that are net loss, some months that are net profit, but overall the company is showing profit at the end of the year. The other thing that we discussed in that previous slide is, for analysis purposes, it's good to put a percentage of sales column and analyze things as a percent of sales. So if we look at this column, these are our total sales, and you can see the percentage of sales under total is 100%. But 80, I got to look at my glasses here, almost 89% of our sales relate to birdhouse sales. Well, that's good information to know, because how does that compare to last year? Are more of our revenues and sales coming from the birdhouses or less, or are our classes becoming more important? And you can see that about 10 to 11% of the bird class or the sales or revenues are coming from the bird classes. In this category, I just put an other here with a few dollars to show that you could have a third category that's other. And in this case, it might be maybe there was some, I don't know, some of the materials were sold that there was a pattern for a birdhouse and you actually sold the pattern for the birdhouse. Well, that might go in this other category because it's different than the actual birdhouse sales. It's not a bird class. And you can look at the detail under these months to really hone in on that if you need to. And it's a small amount in this case. So as we go down to look at the cost of goods sold, we also track the cost of goods sold by these percentages. So we can see that overall our cost of goods sold of the products and the services that we're providing are 38% of our total sales collected. That means that we've got 61 or almost 62% that relates to gross profit. And remember, the gross profit is used to cover all of the expenses, and what's ever left over is our net income. So we actually want to minimize cost of goods sold and maximize gross profit. That would be a goal of any business, because then you're going to be hopefully as profitable as you can be. When we look under expenses, we also have a percentage of sales for all of our expenses. So you can see that this $8,200 of advertising expense is really 3.3% of our total sales. So sometimes you'll hear, well, what's the advertising budget? Should it be 5% of sales? Should it be 10% of sales? Should it be 1% of sales? Here's how you track that and how you would look at that. So in this case, advertising is 3.3% of our sales. If we look at our manager, our payroll, our manager or the admin, it's 65,000 or 25% of our sales. So that means for every dollar's worth of sale, 25 cents goes to cover that manager or those admin payroll wages. So again, if we are looking at that, we would want to maximize our gross profits because we've got to cover all of those high expenses, especially like our wages. And in this case, our second biggest expense is the rent or the lease. So our total expenses are 146,000 in this case, or 58%. So again, for every dollar's worth of sales, 38% goes to our cost of goods sold, 58% went to cover expenses, which basically leaves us with about 3% or 3 cents on every dollar is our profitability. So by having this under this year and being able to track these percentages and look at that, we can compare them to previous years and say, are we improving? Is our gross profit increasing? Is it decreasing? Is our net income increasing, decreasing? What about a percentage of that? Where is it tracking? And by having this data, It helps us analyze the health of our company. Are we improving the health of our company, or is the health of our company getting worse? Okay, so hopefully that gave you a pretty good example of how the income statement is laid out and what we mean by the percent of sales analysis. I'm going to go back to the PowerPoint. This is the data that we just covered, and I'm going to hop to the next slide because we're going to dive into this a little bit further. So when we looked at that percent of total sales, that's a basic analysis. And again, the notes or the verbiage to describe that is we're identifying the major sales and expense, and we're showing those categories with the largest percent, or actually all the percentages, but sometimes we hone in on the largest percentages because if we make a change to one of those categories, we might have the biggest impact where we are either improving or changing our bottom line, hopefully increasing our bottom line. The one thing I want to talk about also with this percent analysis is overall, when you're analyzing an income statement, is let's think about the 80-20 rule. I'm sure most of you have heard of the 80-20 rule, but it basically says that 20% of something provides 80% of the impact. So when we are looking at analyzing an income statement, what I try to point out here is that 20% of the line items have 80% of the impact when on the bottom line, if you will. So let's go back to those slides and kind of look at it. And actually, I'm going to hop over to another. This is, again, an income statement, and it's not by month, but it's by year. So that trend analysis or the percent analysis or the 80-20 rule, sometimes it's easier if we do that analysis looking at annual statements. So what you can see I have here is 2019, 2020, and 2021. What I've highlighted in green for you are the items that are really the 80-20. So under expenses, you can see the biggest impact that you might have are where they're the highest percentages, the highest percent of sales, because these are the biggest expenses. So the three that we look at, the 20% of the lines, or the three top, are going to be the payroll that we talked about, the rent or lease, and in this case, the utilities. So let's say you were super, super busy and could only do the minimum amount of analysis when you're looking at your income statement or your profit and loss. You would for sure want to look at these three line items because they're the line items that you could have the most impact. So for instance, if you can save on wages or save on any hours of admin time, then you could change these, and a 5% change on $40,000 is a much bigger impact to your bottom line than a 5% change in insurance, which is only $2,100. So the same goes true is if the expenses are getting out of control. Let's say people are working overtime, or there's many hours, or you hired an extra admin person, and this goes up by 5%. Well, a 5% increase on $40,000 again is higher than a 5% increase in your utilities, and it's going to have a much bigger impact on your bottom line. So that 80-20 rule, again, look at 20% or your top 20% of your line items because they're going to have 80% of the impact on your bottom line. And if you don't have time to really analyze each line item thoroughly, following that 80-20 rule should help in that analysis. So hopefully that will provide some additional guidance, is just when you're diving in and looking at that income statement, how to really analyze it. So once again, this is just another example of our income statement or profit and loss with our main categories, our sales, our cost of goods, our expenses. And in this case, we're looking at annual statements, 2019, 2020, 2021. Still looking at the percentage of sales in each of these categories. And what we're going to get into now is, if I go back to our PowerPoint, is the trend analysis. So our percent to total sales is a basic analysis. We are going to look at the 80-20 rule. Remember, 20% of the data has 80% of the impact, but we can also look at something that's called a trend analysis. And trend analysis is just what it says. What's the trend? What's happening? Are things increasing? Are they decreasing? Is that good? Is that bad? And we want to look at the trends and say, is our business getting healthier, or is it not getting, or is it getting less healthy? And hopefully we want to strengthen our business and have it more healthy. So in this category, when we're looking in our financial example, our trend, in this case, we're going to look at 2020 and 2021. We're going to look at it by category or profit center: birdhouse, bird classes, and our other. What's the change? Is it positive or negative? Why is it changing? So let's look. In this simple example, our birdhouse sales are increasing from 20 to 21. What's the change? The change is increasing sale. Is it positive or negative? That's positive, because obviously we want to have more sales, because hopefully our business will be more profitable if we have more sales. So that's a positive change. Let's look at bird classes. About 25,000 to a little over 26,000. Again, the change is positive, and it could be because we had more bird classes, or we charged more for the same number of bird classes. So the why is where we might have to do a little research to say, why is there a change? Is it positive? Is it because we increased prices? Is it because we did more work? We sold more product? Is it a combination of both? Because that will help, that research into the why will help us determine, are we managing our business appropriately? Are we making the correct changes? Are we doing, if we are only increasing revenues because we're holding more bird classes, well, maybe those revenues could increase even more if we charged a little bit more, in addition to, in addition to holding more bird classes. It might double the impact of increasing the sales and helping grow that bottom line. It might also help us determine future projections. What's the trend? If it increased from 20 to 21, well, maybe we might have a smaller increase from 21 to 22, or maybe a bigger increase if we decide to increase our prices. So that trend analysis, what's been happening, can help us manage our business and also maybe predict the future. Because if the trends remain consistent and are dependable trends, then we can project our business profitability maybe a little bit better for the next year. I'm going to go back and we're going to dive into that trend analysis a little bit further. So let's go back to our spreadsheet. And if we look at what's happening here, I'm going to put my glasses on because I have to see the numbers are a little bit small on my screen as well. So if we look at the trend, let's look at particular overall sales. So sales in 2019, 180,000, to 2020, 220, to 2021, 250,000. So the trend is increasing with our total sales year to year, 2 years of positive sales. But let's look at things a little bit further. If you can see, in 2019, birdhouse sales were 91% of our total revenue. In 2020, they were 89%. In 2021, they were 88.6%, because we can see that our bird class sales are increasing. They were 8.8% of our sales in 2019, almost 11% in 2020, and almost, well, about a little bit less in 2021. So what that means is our business is diversifying a little bit more. We're maybe less dependent on our revenue coming in solely from birdhouses and now can depend on a little bit more revenue from our bird class sales. And so that's a good thing. Rather than maybe putting all your eggs in one basket, if you can diversify your profit centers or diversify that money coming into your business, that helps decrease the risk of what if something happens to the birdhouse market. And now there's a competitor that comes in, but maybe that competitor doesn't hold bird classes. So you are already in a position, you might be able to increase those bird classes a little bit more and help maintain or even grow your revenue. So by looking at the trend and seeing what's happened, that helps us understand what's happening in our business. And are we doing the right things, or should we be doing different things? Let's look at the gross profit. Remember, we want a high gross profit, or excuse me, let's look at the cost of goods sold. Sorry. We want to minimize our cost of goods sold because that's going to help increase our gross profit. So in this case, let's look at our overall cost of goods sold. They went from 37.7% to 37.9% to 38.3%. So the trend is going the wrong way. Remember, with costs or cost of goods sold, we want to decrease those amounts. But we are seeing that as a percentage of our sales, those percentages are increasing. And the reason why it's nice to use percent of sales here in this case is because our sales are growing. So therefore our costs are automatically going to grow, right? Because we've got to cover the cost of that product, that raw material, that direct labor. But by using the percent of sales analysis, we can hone in and say, yeah, it's okay if our costs are increasing, but they're increasing more than our sale price is increasing. And we can determine that by these percentages. Because remember, this whole percent of sales column is calculated on that percentage of total sales. So again, analyzing that a little bit more, we might say, okay, do we have to find a different supplier for some of our wood? Is our wood getting, are our wood prices getting higher? Because we can see it went from 21 down to 20 up to 21 again. So again, it gives you the ability to say, I might need to look at my suppliers, and we might need to find somebody else and maybe not be dependent on just this one supplier of this raw material. And if you just looked at that number without any of this other analysis, that would be hard to determine, hard to answer that question. If we carry that same kind of trend analysis to the expenses, let's look at our labor. Our labor for our manager and admin was at 40,000 or 22%. Then it went to 52,000 or almost 24%. Then it went to 65,000, almost 26%. So again, the trend is not good, right? The trend is an increase in expense and an increasing percent of sales. So then we ask why, and we do a little research. Well, let's think about what's happening in the labor market. The labor market is tightening. There are less people more people retiring, less people in the labor force. Therefore, we have to pay more for wages. So looking at that, yes, the trend is bad, but maybe there's nothing that we can do about it, because we have to be competitive with businesses down the street. So instead of paying $12 an hour, we have to pay $15 an hour. Or instead of paying $18 an hour, we have to pay $21 an hour. Yes, that's going to eat our profits, but what's the alternative? If we're still making money, it still makes sense to keep the company going. And just, maybe you look at paying higher wages, but maybe we can buy a piece of machinery that takes less labor hours. And that's one way to manage that labor increase. So again, if we didn't have this trend analysis or the percent to total sales to see what's happening with the trend, is it getting better? Is it getting worse? we might not even know that we should ask these questions and really look at our labor force and or look at buying a piece of equipment to help supplement that that work that needs to be done to build those birdhouses. Let's look at another example. Let's look at insurance. Insurance is pretty flat. We're at 21, 28, 28, but as a percent of sales, we're at 1.2, 1.3, 1.1. So it's increased, but it's not increased alarmingly because our sales have increased. And oftentimes our insurance is based on what our sales, what level our sales are at. So that makes sense. Again, if we ask the why, you know, it's not unreasonable that our sales, because our sales have increased, that our insurance has increased as well. Let's look at the 80-20 rule. Here our lease, maybe there's a lease increase from here, but we can see in these 2 years, the actual percent of sales for our lease has gone down because our lease amount has stayed constant. So that's a good thing. That's a good trend. We might say, okay, it makes sense for us to stay in our spot for the next 2 or 3 years, especially if we can keep the lease amounts or the rental amounts at that level. If we look at our net income, we can see it's increasing. So it's a positive trend there. And we can also see that the net income is increasing as a percentage of sales. So basically 1% of our sales was flowing to the net income line in these years, in the 2 previous years, but in this current year, 3% or 3 cents of every dollar is going to that net profitability. And it's kind of nice to look at the change of what's happening there. Oh, excuse me, that was the percent change. So it's 1.3, 2.6, 3.3% of sales are going into that bottom line or that net income, and that's a positive change. Excuse me. All right, so let's hop back to our slide, and as we wrap up the the income statement analysis. So we've talked about trend analysis, and we've done it on percent of sales. There may be some different trends that you track or different percentages that you track. For instance, businesses like lumber yards or large retail stores or carpet stores, they might keep track of their sales per square foot. Their big buildings, or maybe even if it's a retail store that's not a big building, to know what their sales by square foot is, because then they can see it. Are they maximizing that use of square footage? If it's going down, maybe they need to change the mix of product they're selling. If it's going up, what are they doing? Have they changed their product, or are they just increasing the sales price? What's happening? What's positive? What could help increase their bottom line? Maybe your business is very employee driven. So sales per employee, that might be a good analysis. If those sales amount per employee is going down, maybe you have too many employees, or maybe you need to increase your pricing in order to maintain that sales by employee. So every industry has key drivers and rules of thumb, and it's really important to know what yours are, and they're different. Where do you find that information? What's important for your industry to keep track of? Robert Morris and Associates, or the RMAs, they gather, this group or this business gathers financial data and sorts it by NAIC code, which is the North American Industry Code Standardization. So basically, or classification system or standardization. So it keeps track of financial information by industry code. The industry code is the same thing that you would use for your tax return typically. So you can look up what your code is, and you can do some research through RMAs. If you have a banker, bankers usually keep the RMA books or keep this data that you could potentially access through your data. Otherwise, there's sometimes a cost to get this. If your industry has a trade association, can you take advantage and get information on standard industry percentages or analysis that they would do by foot or by employee? What's the standard for your industry? And if you have a trade association, they may provide that information. Your banker can help provide this. Dun and Bradstreet reports or DNBs that you can find online, or just basic internet research can sometimes help you find out what normals are or what good percentages are for your industry. Wrapping up on the income statement or profit and loss, I just want to point out that not only are you going to use the profit and loss or the income statement to analyze your business and look at things on a monthly basis and see how things are going, but you're also going to use it to do your tax return, because your profit and loss ties to the forms that you would use for your tax return. Depending on what type of business you are, if you're a sole proprietorship, or even if you're not, you might use a Schedule C or an 1120S, which is a subchapter S corporation. I'm just going to show you quickly how the profit and loss looks the same as a Schedule C or an 1120S. Let me just go to that. Okay, so here is a Schedule C. It's a profit and loss that you might use for your tax return. And if you look at it, it has the income, it has the cost of goods, it has the gross profit. So you can take your information off of your year-to-date or your year-end income statement or profit and loss and put your sales here, your gross sales, your cost of goods here, your gross profit will be that calculation. And then if you look at, here's an area for all the expenses that your business incurs: advertising, wages, utilities, travel. If your expenses aren't in these categories right here, there is a second section, other expenses, which are detailed here and totaled here, which go back to this line item right here, other expenses. So again, your gross profit, you would back out your total expenses, and that's your net profit or loss. So just the same as an income statement, so is your Schedule C, taking your sales less your cost of goods sold to equal your gross profit, less your expenses to equal your net income or net loss that you would pay your taxes on. Another example is the 1120S. This is an S corporate return for an S corporation. And if you can see, again, here's your gross receipts or your sales, less your cost of goods sold, which gives you your gross profit, less all of your expenses, which ultimately gives your income or your loss again. So when you meet with your accountant or you're the person that does your taxes, or if you do them, that's the relay of information from your income statement to your tax return. So it's a dual purpose. You use it to manage your business on a monthly basis, but you also use that information to file your tax return. So if we revisit our goals, our first goal today was to learn how to read an income statement. I'm hoping you got a few more tips, not also learning how to read that income statement, but also how to use that data to analyze it. Percent to total sales, percent analysis, as well as the trend analysis. What's happening? Is it positive? Is it negative? Why is it happening? And let's control it to help us manage our business better, to be more profitable. So that's the income statement or the profit and loss. Let's move on to the second goal of our class today, and that's balance sheet basics. So the profit and loss or the income statement is pretty easy to understand. The balance sheet can be a little bit more tricky. And so we want to break it down into those few components again, because again, just like the profit and loss that has 3 components, so does the balance sheet. It has assets, liabilities, and equity. Those are the 3 components or the 3 categories of a balance sheet. The assets are what you own or what the business owns. The liabilities are what you owe or what the business owes. The equity is what the business is worth. So the worth of the business. And the formula is that the assets are going to equal your liabilities and your equity. So what you own equals what you owe and what you are worth. That's a funky calculation, and I'm going to show you another way to look at it that might be easier, but that's basically the balance sheet formula. And the reason why they call it a balance sheet is this side, the assets, has to equal the liabilities and the equity, or the other side. Otherwise, your balance sheet doesn't balance and something's wrong. So a quick check, if you currently have a balance sheet, is to make sure it balances. Do your assets equal your liabilities and equity? If it doesn't, something's messed up in your accounting system, and that needs to be corrected. So that's the first thing that you should look at, is to make sure they balance. Unlike a profit and loss or an income statement, the balance, which is over a period of time, a month, a quarter, a year, a balance sheet is at a particular point in time. So it's at a single point of time. It's what your assets are on this day. Liabilities are on this day. Equity is at this point in time. Again, just like the profit and loss, you would want to run those reports at the end of the month, at the end of the quarter, at the end of the year, because again, all the activity should hopefully be completed at the end of the month, at the end of the quarter, at the end of the year. Okay, so income statements, profit and losses over a period of time, balance sheet at a point in time. So let's move on to talk a little bit more. Again, the assets is what a business owns. They need to equal the liabilities, what a business owns. And that would make sense. If you have a liability, you owe somebody that liability amount, plus what you're worth, the equity or the value of the business. Let's look at this formula a little different. So this is the basic balance sheet formula, assets equals liabilities and equity. But maybe in your mind, it's easier or more intuitive to think of it this way. Assets less liabilities equal equity. So let's think about that. Assets, what you own, minus liabilities, what you owe, equals equity, what you're worth. So what you own minus what you owe is what you're worth. It's the same, this is the same really calculation, the same formula, but this might just be a little bit more intuitive when you're thinking about that. So let's dive into the balance sheet a little bit further. Let's look at some key points in the balance sheet. We talked about assets, and under assets, the things that you owe, cash is king. We want to make sure that our cash is sound and we have always a positive cash balance. So that's one thing we look at when we analyze our balance sheet. We would want to make sure that we've got growing cash or stable cash. Accounts receivable, when people owe us money, we've sold something and maybe we don't collect the cash right away, but we give them terms and they're going to pay it later. That's something, people owe us something. We own that money, that accounts receivable. We just haven't collected it yet, but we want to make sure that our accounts receivable don't get too big, because basically, if you have accounts receivable, you're the bank. Because the person who bought that product or you provided that service to, if they didn't pay you right away, you've paid for that product, you've supplied that service. but they haven't paid you. So you're basically kind of loaning them money, if you will, for the people that haven't paid you yet. So you want to make sure that your accounts receivable don't get out of whack and you keep those under control. Your inventory is, if you're a manufacturer, you sell a product, your inventory can be either be in the form of raw material or finished goods. And you want to make sure that you don't keep too much inventory. You want to turn or sell that inventory as many times as you can, because otherwise it could become stale. And I always tell businesses, if you have too much inventory that sits on your shelf for a really long time, those are dollar bills sitting on your shelves that you aren't using. So inventory management is huge. Liabilities, what you owe. If you buy materials to do your to make product, or you buy something and you don't pay, you have an accounts payable, you have a liability. What's an accounts receivable for the people that you purchased that product from is your accounts payable. And again, now they are the bank, the people that you bought that product from or that provided that service and you haven't paid them yet, they're basically being the bank, and they're providing you use of your cash without paying them yet. So again, you want to manage that. If you can take terms, maybe it makes sense for you to wait to pay at the end of the month versus right away. Maybe if it doesn't, every business is a little bit different, but looking at your accounts payable and managing them is super important. Another liability might be debt. If you take out a loan, that debt or that loan is a liability. You owe that, you have to pay that back. Excuse me. And the last thing component which is equity, which is that third component, the value or the worth. It's really the value of the company. And here's one of the points that I want to make is the income statement and the balance sheet tie. Your income, your current net income, is a part of your equity. And that gets a little confusing, but I'm going to show you via the spreadsheet of how that works. So let's look at that. Your balance sheet links to an income statement as long as you are always using the same ending date. So again, your balance sheet links to the income statement. Make sure you run your reports at the same time using the same ending date, because the net income, which is from your income statement, is reported in the equity section of your balance sheet. And let's take a look at that. So first of all, let's look at a balance sheet. So in this case, all about birds or balance sheet, again, we have assets equals liabilities and equity. So let's make sure that my balance sheet actually balances. You can see that my assets equals my liabilities and equity in both cases. I'm using, this is a 2-year comparison. We can also see that we talked about under assets, things that you own. So what would you own? You own your cash. You own your accounts receivable. You own your inventory. Other things that you could own might be a building or equipment. And those are also things that are categorized under your assets. So here's an example of that. When we look at your liabilities, things that you owe, well, your accounts payable. If you've bought materials and you haven't yet paid for that, that's something that you owe. Payroll taxes payable, sales tax payable. If you pay those at the end of the quarter, you might have some months that have accumulated. You owe those, but they haven't been paid yet. Those are all liabilities, things that you owe. Here, if you have a loan, particularly a loan on equipment, that again would be a liability, and you would owe that, right? Okay, so let's go to the equity section. Here is that net income. So if we look at this year, which is 2021, and the net income that's reported under the net equity section in your balance sheet, let's make sure that ties to the net income on your income statement, and it does right here, 8320. So another check to make sure that your statements and your data is flowing correctly is that your net income on your income statement is appropriately the same as the net income under the equity category in your balance sheet. If they're not, first make sure that you've run the report on the same date. If it's the same date and all the data is there and they're not the same numbers, something's up. There's a problem and you would need to do more research to figure out what's happening and why that isn't the case. The second place that that data from your income statement flows to your balance sheet and the two tie is in depreciation. So we are back at our income statement, and one expense in our income statement is depreciation. So this is the current year depreciation. So when we look at our balance sheet, we can compare and look at, this is accumulated depreciation. So on our assets, what's our total depreciation that we've expensed throughout the year or throughout the years? And the total is what's reported under the balance sheet. But this change from 20 at the end of 20 to 2021. So basically what's the depreciation amount that's occurred in 2021 is $4,448. That's the actual depreciation expense in 2021. It flows to your balance sheet because we take the balance at 2020 and we add that expense in 2021, and that's our total accumulated depreciation in 2021. So again, that's another place that you can check to make sure that the information is flowing through appropriately and that that amount ties. So when we look at back to our PowerPoint, our balance sheet links to our income statement if we use the same ending date through net income, as well as depreciation expense and accumulated depreciation. This gets a little bit tricky, but one of the other things, if you guys have loans, what happens when you have a loan? That loan amount gets reported on your balance sheet. So let's look at that example. So here is the loan amount. And I don't know what year this is taken out, but you can see that the loan amount is decreased from 2020 to 2021 because you've made payments. And the principal portion of those payments get backed out of the loan balance to decrease the loan balance on the balance sheet. So when you have a loan and you make a payment, that payment is comprised of two parts: interest expense and the principal portion of the payment. Your interest expense is expensed on your income statement. The principal portion is decreased on your balance sheet. So that's another link between a balance sheet and an income statement, is when there's a loan and you make a payment, it's going to affect your income statement because you will have an interest expense right here. So what gets booked as an expense underneath your expense area in your income statement is the interest portion. What gets booked on your balance sheet as a decrease of liability is the principal portion of your payment. So again, the two reports link through loan payments as well. That gets a little tricky, but I just want to point out that it's important to understand your balance sheet because information does flow from your income statement to your balance sheet. And when you have loans, it affects both your income by deducting your interest expense and your balance sheet by decreasing that loan amount by your principal portion of your payment. So when we look at analyzing your balance sheet, I'm not going to get into a lot of this today because I want to be able to touch on the projection a little bit, but balance sheet, we would want to use that comparison or that trend analysis as well as ratio analysis. Without looking at the trend or comparing or the ratio, it's hard to tell if things on the balance sheet are good or bad. So let's look at our balance sheet and let's look at the trends and see what's happening. So by looking, if we would just look at 1 year in particular, we wouldn't know, is the cash better off or in a better position than it was previously? But if we look at the previous year at the same point in time, we can see that cash has increased by over $5,000. That's good, right? Because cash is something that we own. That's a positive effect. We can see that inventory is decreased a little bit. Well, maybe we're controlling our inventory and we don't want those dollars, that inventory sitting on the shelves, and we can get by with less inventory. So that might also be a good change. Excuse me. We can see that we bought a little bit more of equipment. We've bought something for $500 because you can see our equipment was $68,000 in this year, and now it's $68,500. And again, that's just by looking at the trend, by comparing the numbers and seeing what's happening with those numbers. Let's look at our liabilities. Our accounts payable is increasing. Is that good? Well, maybe if it's good if our suppliers of our material are okay, or we're still current and we're paying things within 30 days. But if we're getting late on our payments, maybe that account payable increase isn't so good. Again, let's look at that and say, if you look at it and analyze it, you'll know what the situation is and are we doing things appropriately or do things need to change? We can see that our loan on our equipment has decreased dramatically. $7,000 has been lopped off that loan. That's a good trend. A decreasing amount in a liability or what you owe is good. So equity, that we can see that this capital amount is the dollar amount that we have put in to start our business. That's our capital injection when we started our business. It's the same. We haven't had to put any more money into that business, so that's probably good. It means that our operations are maintaining those balances that we can use to manage our business. Retained earnings, I just want to point out a little bit. Retained earnings is the accumulation of all your net incomes or net losses since the beginning of your business. Let me say that again. Retained earnings are the accumulation of your net incomes or net losses since the beginning of time. Let me show you what I mean by that. So in 2020, our retained earning was $14,000. It went up to $20,000, a difference of $5,804 between the 2 years. And that is because this is our net income for 2020. Let me get the right year. For 2020, what is that? 2020. So this amount, our net income, gets added to our retained earnings from the previous year to get our new retained earnings for the next year. Then in the next year, we take our net income from that year, add it to our retained earnings, and that's going to be the balance for the next year. So if we look at our balance sheet, this 14,000, we take our net income right here. There's where they tie the net income, and those two amounts get added to equal the retained earnings for the next year. If we were going to do a future year profit and loss, our retained earnings would be $28,327, because again, we're taking our current balance and we're adding their net income, and that's going to be the future net or the future retained earnings for the next year. So again, another way to check your balance sheet to make sure things are flowing correctly. Okay, so the last thing about that trend is looking at our equity. Remember what our equity is, what our business is worth, and the trend is positive. It was worth, quote unquote, our equity was 45,000 in 2020. In 2021, that balance went up to 53,000. So technically, our business is worth more in that current year, and that's a positive trend. Again, if we wouldn't have compared it to a previous year, we wouldn't know, are we doing things right? Are we doing things, are things going badly? So I'm just going to briefly touch, and because you have the handout and you'll have this data, balance sheet ratios. So when we look at the ratio analysis, and I've detailed these in the PowerPoint, but I can give you some analysis here. Excuse me, I have some examples. Inventory turnover is a ratio that says, how many times is your inventory turnover? Does it turn over? The more it turns over, probably the better, because we're getting those dollars off the shelves and we're turning them over into sales. So our cost of goods sold that we can get off of our profit and loss divided by our inventory balance will tell us our inventory turnover. And in this case, you can see the trend that the inventory turnover is increasing. So that's probably good. We're turning over that inventory. We're selling it quicker. It's sitting on our shelves less. That's a good thing. Let's look at an average for accounts receivable, an average collection period. So we say if there's 360 days in a year, and how fast are we collecting that? If our accounts receivable turnover, so here's our sales, which we get off of our profit and loss. Here's our accounts receivable balance. So our sales divided by our accounts receivable is 93. So that basically means that we turn over our inventory, or we turn over those, not inventory, receivables 93 times a year. That's a lot. We don't have a lot of accounts receivable. That's good. And if we look at what our average collection period is, 363 divided by these 93 days says our average collection period is about 4 days. That's super quick. So that means we're not being someone's bank. We are collecting our money quickly, and we're utilizing that money. So we don't have a ton of time, because I've actually, I guess, taken more time explaining other things, but inventory turnover, accounts receivable turnover, all these balance sheet calculations. Here is the numerical example along with the definition. And if we go back to the slides, which you will have access to, I say, are they good or are they bad? So we talk about inventory turnover, higher is better. Inventory turn days, lower is better. So you're going to have the detail behind a lot of these ratio calculations and that ratio analysis to say, where do you want to be? Do you want to be high or low, or how does that fit your business? So that was a little bit quicker than I wanted it to be, but I really want to get to the projection. So you'll have all that data and all that ratio information. So last but not least, I want to talk just briefly, because we have about 12 minutes left, of our projections. And our cash flow projection, which I like to use, measures our inflow and outflow of cash. And because we think of cash as being king, is that positive? Do we have a positive cash position? Do we have a negative cash position? And by trying to project some of that, it will help determine if you've got some seasonality in your business, and if we have to be concerned or potentially get a line of credit for maybe some of the months that we might have a shortfall. So cash flow mimics the bank account balance. So if all of your inflows and outflows of cash were going to go into one account, we're trying to look at that end of the month balance. It reflects the seasonality of your business. What are the slow months? What are the busy months? And it's very important in our area. I live in Nisswa, the Brainerd Lakes area. Many businesses are dependent on tourists as well as weather. And so by doing that cash flow projection or projecting out on a monthly basis, we will determine what months there might be some tricky months to be in positive cash flow positions versus other months we might have a very solid cash flow position in our summer months. And it helps you project, can you pay your bills, or how will you pay your bills, or how much money do you have to have at the end of the season that will help cover those shortfalls that you might have in your slower months or those winter months of the season. So we're going to hop right into an example, and I'm going to look, I'm going to show you what I have in the data that I've provided. I basically have this template. And if we look at it, it starts with the beginning cash balance. We add our sales or our inflows right off our income statement. It gives us the ability to detail our cost of goods sold. And then here are all of our expenses that we have. It also lets us put in an amount for both the principal and the interest portion of a loan payment. Because even though on the income statement, only the expense, the interest expenses is reported, principal and interest are cash flow going out of your business. So if we're looking at a cash flow projection, we want to include both the principal and the interest. We can see that the ending balance, it gives us an ending balance at the end of the month. That ending balance of this month is going to be the beginning balance of the next month, and it'll flow through. So what it provides is that end of the month cash balance that's going to help us determine, excuse me, do you have enough money to pay your bills? Do we have positive money in your bank account, which is super important. And if we look at that, here's an example of a cash flow projection where we would say we get our beginning cash balance, and that's right off of our balance sheet at the end of December from the previous years. And then we're going to say where are inflows, and we're going to get money from birdhouse sales that we projected, money from revenues for bird classes, and maybe again we've got this other revenue that's coming in. If an owner has to provide some money to help support the business, that would be an inflow and could be projected here. Hopefully that's not the case. And then we'd also project our outflows from materials and labor, advertising, insurance, all those other things. And we can see that the end of this first month balance, our balance decreased to 13,000. That 13,000 pops up and is the beginning balance of this month, and we flow through. And now that 13,000 goes down to 9, goes down to 5, goes down to 2, goes down to 6. So what we're seeing is these are our slower months. And if we look at that, our revenues are lower in these months. In the summer, like many tourist areas, our sales increase, and we can see that our bottom line increases as well. Christmas can also be a big month. And if we look at our sales up above here, we have a couple bigger months at the end of the year because of Christmas and people buying for the holidays. And that helps at least maintain a positive balance in our cash account. So in this particular version, we haven't looked at inventory or accounts receivable or payable changes. That would be probably a whole nother class. I do have an example of that, but here's a quick check. Our beginning balance was 18,000. We add our sales of 293. We subtract our expenses of 282, and our ending cash is 29,000, in which we see that here. The good thing about projecting it this way is, let's say our sales were $5,000 less in one of these first months, we would see that our balance is going to go negative. And if it goes negative, how are we going to cover that? So if I just back out, if I put this at 0, we can see that all of these went negative, and now we have to plan accordingly how to cover that. So that's why it's good to look at the next year on a monthly basis and look at how our cash position is going to be. Is it going to be positive? Might it go negative? Will we have to put some money into it on our own? Will we have to get a line of credit from the bank to help mitigate those downturns in our sales and keep a positive cash balance? So that was a lot of information. I want to save 5 minutes for questions. If anybody has questions, you are going to get all of the these spreadsheets. It's under one file, and you are going to get that information as well as this template. That's the basic one. You will also have access to the slides, the PowerPoint. And so hopefully what we've talked about today, the slides and the PowerPoint, as well as the numerical examples, will be helpful. And I believe Hannah is going to be able to put this online, so you could go back and look at data or revisit the presentation if you have a certain question in a certain spot, and you'd be able to do that as well. So I'm going to stop sharing my screen, and I'm not sure, Hannah, if we had any questions from anybody, or if anybody has any questions now that they would like to ask. We've got a couple minutes before we're going to wrap up.
Yeah, thank you so much for joining us, Julie, and everybody who joined today in person. Thank you guys so much. This will be up on our YouTube channel. If you have any questions, now is your time. I know I have a ton of questions. We got one person saying no questions for me, but thank you for your time. It was great.
Oh, good.
All right. If anyone else has any questions, please either drop them in the chat or come off of mute.
And I do just want to say that's a lot of information, especially when you start tying information back and forth. And so feel free to go back and look at those numerical examples and kind of trace it through. Or if you're already in business, go back and do some of this analysis with your own financial statements, because it's easy. You know, if they're your numbers, the data is going to make more sense, or the concepts will make more sense when you're actually using your numbers.
So one of the questions that came out in my head was, you had mentioned looking at trends and trend analysis, and it looks like you had 3 years up. Is that pretty standard for every industry, or is that changed through?
3 years is really a good comparison, but the one thing that the caveat to that is, with COVID, all bets are off, because 2019 might have been a normal year, but then 2020, 2021 weren't normal years necessarily. And maybe now 2022 is more of a normal year. So you might even look back, the analysis might be 2018, 19, and 2022, because your business was in upheaval during COVID. So I would say, yes, 3 years is a really good look back period, but you have to also pay attention to what's happening in the industry and what's happening in the world as well.
Yeah, it's a really good point. Yes. Perfect. And we have one question here. I'm wondering if the average person could set up those spreadsheets / formulas. That's a great question.
If you know Excel, it's pretty easy to set it up. I will say that if you join the next session 4, we're going to talk about resources. And one of those resources is working with your local SBDC, Small Business Development Center office. That's where I do consulting from, and I help businesses do this a lot, helping understand a projection, helping them set that up. Your accountant could help you set that up. Potentially, if you have a bookkeeper, they could help you set that up. But if you are like a solo shop, join in next session, because we're going to give you tons of additional resources. Or if you can't join next session, make sure that you try to look up what SBDC or Small Business Development Center is in your area and contact them, because they will more than likely be able to assist you with that.
Awesome. And I do have a similar question. And maybe I think you just answered it, but where should somebody start? So I know that the answer will change with the scale of your business, who you are, but do you have any recommendations, either where to start or how to look for maybe free online help or
Yeah.
additional
So
resources?
next week's going to be really good, but your SBDC or SCORE, Service Corps of Retired Executives, is they have really great mentors as well. So SCORE, Service Corps of Retired Executives, they have a lot of online stuff, which I'll give you examples of next week. Or your SBDC, or if you are going to hire a bookkeeper or an accountant, they're going to understand these reports, and they're going to understand what an appropriate way to set them up is for you to manage your business. So if you know you're going to engage or enlist those services, having a conversation right away with that person or that firm would be a good place to start as well.
All right. Does anyone else have any questions for Julie? See, the chat is pretty empty. One question that I had, and maybe you answered it and I missed it. There was a lot of information. You had mentioned about filling in those spreadsheets and having too much information and having too little information. Does that vary on what industry or the scale of your business?
I would say yes, because it really depends on what you're doing. If you have 5 distinct profit centers that you're getting revenue from very different places, having 5 profit center line items on your sales category is totally appropriate.
Mhm.
If you really don't, and you're just splitting out a bunch of detail that doesn't really need to be split out, you're making more work for yourself, right? Because you have to look at those 5 numbers every time versus just looking at one number, if that makes more sense. So really look at what information you're going to need to manage your business. And if you don't need it and it can be combined with something else, do that. If you really do need to know that number to manage your business appropriately, by all means, have a separate line item for that. And so it's really dependent on the industry and your business.
Okay. Awesome. Well, thank you again so much to Julie and everybody who joined us live today. This will be on our YouTube channel, and Julie, we'll see you next week.
See you next week
Hopefully
for more
everybody's here
resources.
too. See you
Yeah.
next Thursday. Thank you so much.
Thank you. Bye, everyone.